Hello, I'm Rick Buczynski, Chief Economist at IBISWorld. Welcome back for those of you who tuned in to my previous podcasts and webinars, all related to the economic and financial impacts of the COVID-19 pandemic. Today is episode 8 of this series. As these were primarily geared towards commercial banks, I centered on lending risks and opportunity, primarily dealing with commercial lending. Although keeping this theme alive, I'm going to shift gears and focus on the labor market and the recent unprecedented surge in unemployment. I'll employ data from the broad Bureau of Labor Statistics household survey. The objective today is to determine the industry segments where employment will likely rebound most quickly and which will lag behind a general recovery. The end game will be to assess credit quality for both consumer and commercial lending and take a look at state and local government financing. Today, I'll cover some basic labor market issues as a backdrop for the next couple of weeks of more granular analysis. So here's the basic architecture of how I'll structure the next several webinars, looking at how unemployment impacts 3 separate lines of business. And importantly, what are the relative degrees of these impacts? For commercial credit, I'll consider C&I, commercial and industrial loans, CRE, commercial real estate, and agricultural lending. As for consumer credit, I'll entertain home mortgages, consumer loans, and credit cards. And finally, in regards to state and local government finance, I'll discuss the bond market. As I mentioned, I'm going to disentangle this in a very disaggregated, granular basis in forthcoming weeks. But first, let me spend the rest of today running through some of the basics of the labor market. Realize that this discussion deals with national trends, but these should still have significant relevance for a bank's geographical footprint. Here, check out the national unemployment rate, the red line representing the dramatic surge in April, almost 15% national unemployment rate, much higher than the peaks hit during the Great Recession. May's labor market report is likely to show an additional erosion. We'll see. Note that state-by-state variances are great. The worst states, those where more than 1/4 of the workforce has filed for unemployment benefits, include Kentucky, Georgia, Hawaii, Rhode Island, Michigan, Nevada, Pennsylvania, Louisiana, and Washington State. So what about the gap between the standard headline unemployment rate that I showed on the previous slide and the so-called U6 rate? Well, the gap jumped to 8% in April, nearly a full percentage point greater than that endured during the Great Recession. The U6 rate includes the standard percentage of the labor force that is unemployed, plus discouraged workers who have quit looking for a job and part-time workers that are seeking full-time employment, the underemployed. The U6 rate is considered by many economists to be the most revealing measure of a country's unemployment situation. And look how long it took the U6 rate to recover during the last cycle, nearly 10 full years. It shouldn't take that long this time around, but there will be undoubtedly some stickiness. In this context, let me provide an observation made by my IBISWorld colleague Rob Miles that will be thematic for the entirety of this series. Here it is, as regarding the impact of the increased spread between the headline unemployment rate and the U6 rate. Here it is. Which pockets of the economy, both industry and geographic, will be the most sticky, and how does this impact labor participation rates over the medium term? Certain employee types are more likely to be pushed out of the labor force or simply abandon their reduced hour positions. The mass reopening of states had only just begun, but I can't imagine retail or personal services businesses using full staff for at least the next few months. All of the reopening is suggesting 25 to 50% rehirings for the first few stages in almost all industries. Great observations. And doesn't this all concur with the swoosh recovery shape we've all been reading about of late? Let's drill down a bit and see which major sectors have been hit the hardest in April. In the webinars that follow, we'll drill down even further and assess the damage and potential for recovery for a variety of industry groups. This will indeed help determine which consumer lending and commercial loan businesses are under the greatest risk going forward. The chart here illustrates the number of unemployed this April compared with a year earlier. It's no surprise that workers in leisure and hospitality and wholesale and retail trade suffered considerably. Note that retail endured the bulk of losses in trade owing to social distancing. Professional and business services were also among the casualties, but we'll have to disentangle this in a future webinar since there is a wide dispersion of labor market performance in this aggregated group, thus suggesting an uneven recovery. Manufacturing was highly stressed, but this was concentrated in the production of durable goods, this being the same pattern observed in previous economic downturns. Again, we'll unscramble this subsector in greater detail in a subsequent webinar. And finally, the cycle-dependent construction sector was among April's most serious victims. Here are the same industry groups looking at unemployment rates, not levels. The red line is the demarcation illustrating labor categories above 10% unemployment. As a point of reference, the overall national unemployment rate peaked at around 10% during the Great Recession. By the way, note the catastrophic unemployment rate for leisure and hospitality workers, sadly unprecedented, and many of these are low to middle wage earners. Next, look at the difference between the current unemployment rates and the 2009 through 2011 averages, where many past peaks occurred. I'll use this as guidance in forthcoming webinars. Comparing cycles and the reasons behind the crashes of GDP will be useful at evaluating the potential strength of a hiring rebound at a very granular basis. Actually, a 5-digit NAICS basis, so stay tuned. So how important are unemployment rates in determining key performance indicators? Are they useful in predicting delinquency rates and net charge-offs? In short, are they correlated to unemployment statistics? And if so, to what degree? This is bottom line stuff. The case in hand here, consumer credit. Be reminded that this data is on a national level, but I'm confident that there is relevance in your footprint. On the first table, the standard unemployment rate appears to be as good, if not better, as a determinant of delinquency rates than the U6 figure for consumer credit. After all, the Fed's DFAST CCAR stress tests had this variable as a central assumption. Here's a takeaway for you. Unlike other potential drivers, unemployment data is released monthly with a high frequency. By the way, in early June, we'll have the May figures. Plus, there is a statistical connection between delinquency and net charge-offs. See the second table. I'm not a banker, though I surmise that net charge-offs don't reflect the total burden. Aren't there additional workout costs and opportunity costs as well? So what's the conclusion here? Unemployment rates plus delinquency rates are indeed key risk indicators. On this chart, check out unemployment rates versus delinquencies for single-family mortgages. They fit like the proverbial glove. The red vertical line depicts the start of the Great Recession. Realize that the residential mortgage deluge that many think triggered the Great Recession actually started to ramp up well before the official start of the recession. Incidentally, IBISWorld's industry early warning system red flagged the housing sector, including many construction contractors tied to the segment in early 2005. No, we didn't predict the Great Recession, but we did indeed provide an across-the-board warning that trouble was brewing for the housing market and for its lenders. As for the relationship between unemployment rates and delinquencies for consumer loans, see this chart. Again, the red line clearly depicts the start of the Great Recession. You don't need to have a Ph.D. in statistics to see the correlation. To paraphrase what Stanford University's Professor Sam Savage suggested in his 2009 book, The Flaw of Averages, just plot a scatter diagram and think. By the way, this is the best of dozens of stat books I've read in my life. And finally, notice the same pattern for the relationship between unemployment rates and credit card delinquencies. This chart depicts delinquency rates for all three categories of household borrowing I just discussed. I wonder how this translates into charge-offs and losses in the future. That's the real question, particularly given government aid policies that are changing by the minute and the actions of creditors, or should I say reactions of creditors. Perhaps the financial world has flipped on its head. It will take a creditor obviously longer to foreclose on someone's home mortgage than to cancel a credit card in the face of mounting 30, 60, and 90-day delinquencies. And consumer loans are a morass of educational, auto, plus an assortment of miscellaneous loans, thus adding to the confusion. Bankers will just have to disentangle these lines of business and apply common sense. Let me march through the commercial credit side, as much of the results are similar to what I discussed for consumer lending. Remember, these are national level statistics, and the red lines depict the start of the Great Recession as a point of reference. Feel free to peruse the next few slides at your leisure. On the first table here are the correlations between unemployment rates and delinquencies. On the second table are correlations between delinquencies and net charge-offs, all significant, all relevant. Here are unemployment rates and 30-day plus delinquencies for commercial and industrial loans. And the same data for commercial real estate. And finally, here's the data for agricultural loans. All of these tracking closely with unemployment rates, as expected. And for your reference, here's a chart comparing all three line of business delinquencies historically. Feel free to pause here and take a closer look. So, where are we headed in the next several webinars? We're going very granular. We'll even drill down to 5-digit NAICS as needed. Check out this schematic. In the next episode, we'll start with employment prospects and associated labor market risks and opportunities in manufacturing, durables versus non-durable goods. So that's it for today. Till later this week, stay safe and Godspeed.